Welcome to Quiver Financial's market update for October 2023, where we're going to discuss what's hot and what's not in the stock market, energy and metals, inflation, and it's been a while since we've talked about real estate, so why don't we throw that in as well. I'm Colby McFadden, and I'm joined by my esteemed colleagues, Justin Singletary and Patrick Moorhead. Gentlemen, welcome. It has been quite a while since we've gotten together, and a lot's happened in the last couple months. I think, Justin, you had some exciting news of getting married, so congratulations.
Thank you.
It's a big thing to move out of your mom's house and marry your sister, so congratulations.
Well, I succeeded in both.
Yeah, when are you moving to the South with your sister?
December.
Well, perfect. That's good.
We're going to
proud.
go where it's acceptable to be married to your sister.
Yeah, you'll find the right place. All right, so there's a lot that has gone on since we really all got together March, April, May timeframe. So let's start off with the conversation, gentlemen, with the stock market, because that's the thing we get the most questions about. That's what people want to talk about. And I think that's going to be a lot of activity in the stock market in the fourth quarter of this year. So it's definitely worth talking about. So I'm going to go back to go forwards, to figure out where you're at. Sometimes you got to look at where you've been and remind everybody that really since December, so it's amazing. It's almost 10 months, but since December, of 2022, we've been postulating that the stock market's been in a bear market rally, meaning that it made a low in October of 2022, has been going up in price, but we didn't feel it was going to go beyond its old all-time highs, which were around 4,800 on the S&P 500, if I'm right. You guys might want to double check that for me. So just, here, and we had said that we thought the market was going to rally to about 44 to 4,600 on the S&P, below the old all-time highs, and then eventually fail. So here's the chart that we shared multiple times from December on. And gentlemen, where did this rally that started in October look like it's peaked out? At least recently it's peaked out where? Somewhere around what was it?
40.
Anybody? 4,600?
Yeah.
4,600. Yeah. So at the high end of the range. And so, the question has come up from some people, well, what makes you so confident about about this being a bear market rally? Because a lot of people in the last few weeks, as you got into June and July, a lot of people were getting really bullish, especially with the action in Nvidia and Apple and what they call the Magnificent Seven, the Apple, Nvidia, Microsoft, that like they were moving the whole market. And a lot of people that were making money on those things in the NASDAQ were getting really bullish in July. And in August, we put out a little update saying, hey, we still believe that this is a bear market rally because we were seeing these inner market divergences that were, hey, when we see this S&P 500 rally back almost to its all-time highs, but the higher risk components of the market, which should lead that rally, weren't. So what are those things? Like junk bonds. So I learned a long time ago that when institutional investors are feeling frisky and it's a bull market with legs, they're going to lead that investment thesis with junk bonds and small caps. So we were seeing that the small caps didn't rally anywhere like the S&P 500. Same with the small caps, and financials seemed to be leading the downside when the market started to turn at the end of July. So where are we now, gentlemen? Oops, excuse me. So now where are we? Are those divergences still there? Absolutely. In fact, now that the S&P 500 has broken this trend line, you can see how junk bonds, small caps are leading to the downside along with financials. So this is leading me to believe that, our call that this is a bear market rally has been accurate. And it means that the future for the stock market, and it's not going to go in one direction, but the future over the near term looks like the momentum has changed from up to down. So I threw this chart in there for everybody because this week or last week we did break a trend line that when you break these trend lines, it's kind of indicative that the short-term momentum has stalled. So I threw some targets up there of where we could go. So what do you guys think? I mean, what are your feelings about the stock market and our call on being a bear market rally? Are you still confident in that, or are you feeling otherwise?
Well, a lot of this coincides, the Fed's raising interest rates, which we'll get into in a little bit, but they're also rolling off their balance sheet. And if you
Yeah.
look at how much they've reduced their balance sheet, kind of coincides with the top of the market of the 4,600 and on down to this. So if they continue to try and do that, the days of the QE of propping the market up, now they're just deflating the market, bringing that back down. So it gives us a little more emphasis of that. And this bear market, to the high end of the 4,600, like we said, part of it is from that AI push. A lot of that NASDAQ stuff was supposed to roll off back in June. And because of the NVIDIA and the AI bubble and all that type of thing that's happened, time and time again of a new bubble that's come in, pushed the market much higher than it should have. So we've overstretched on the bear market rally side.
Yeah, you bring up an interesting point that the liquidity factor, like what pushes the stock market higher is liquidity, and if you have the Fed rolling off their balance sheet, basically doing quantitative tightening, that has a negative effect to the liquidity. And what's amazing here too, and Justin and I have talked about this quite a bit recently, is in this same time frame, you've had a crazy yen carry trade. Like the yen has been incredibly weak against the dollar. And that's another form of providing liquidity to a market. And that, even with that, I mean, there's been a huge advantage on the yen carry trade, and market wasn't able to get to new highs. So you can see that the liquidity factors between central banks, they're not coordinating to push things higher. They really are trying to, create more of a stagflation scenario where, you get a balancing out of all these factors. So I would say that's a good observation on your part.
Yeah, my only add here would just be that, I think we actually sell off probably down to 4,200, probably a little bit of a cooling off period there for, maybe a little bit of a rally or bounce. But I think after that, we hit that target one, probably another cooling off stage where there's, perhaps a little bit of consolidation, and then off to target two. But yeah, I mean, clearly last week and this week, and based on like what Patrick had brought up, there's a lot of negative aspects to the overall market. One thing to point out, you mentioned throughout the last year and this year in our videos, is the little tag there. It says expanded flats. And if you look at, what was it, February, March of 2022, and then where we are today. So maximum frustration to the maximum number of participants. We talked about trading in a range, and that's pretty much what it's done for just over a year.
Yeah. Yeah, these expanded flats are nasty, and it's been a long time since we've seen one in a big major top. This is where some experience from '08 comes in, and what I saw then and what I experienced then, I'm starting to see again. And so in these expanded flats, what happens is, it wasn't too far back. It was just right around in this time frame, right in here. People were still really negative the market. People were still thinking the market was going to go break those October lows. And when we broke this resistance here, when we took this last leg up, that's what got everybody who was negative of the market positive of the market. And that's why these expanded flats, when they fail, they can cascade down really fast, because right here, a bunch of people change their positioning from being short the market to being long the market, and they change their posturing, right? Their belief system, and put money to work. And if we start breaking below 4,200, this can speed up pretty quickly. It's important to note too, though, what if we're wrong? Justin, what if we get down to 4,200 and we grab some footing and we're off to the races to new all-time highs? That we always got to think about the flip side of the coin. I don't think that's a probability, but we have to keep it as a possibility that if this market comes down a little bit lower, then starts to rip towards, a new all-time high, where do you adjust your posturing? And right now, basically, if you stay below, I would say the line of demarcations is the combination of this upward sloping trend line, that if you're below that, you're probably selling the rips and rather than buying the dips. And you take that until, you continue that until another trend line develops somewhere around 4,200. And then you can start to use that as your future line of demarcation. But right now, it does look like the market wants to go lower, so I would lean into it. And my risk management would be, I'd reevaluate if we started to get back above 4,400. That's now. Ask me in a month, or ask me in 2 months where I would put my risk management, because that will change in the future. Patrick, what do you got?
Yeah, I was going to say that, we always try and look at both sides of things. And, a lot of people are probably looking at this as, buy the dip type of deal. It's a risk off there. We have this all the time, the believers that this is not a bear market rally. We're going to go higher. And I mean, I've tried finding things that would really cause us to rally higher. Like, there's really nothing in the data other than, and I just saw an article today about manipulation. The options market has become so much of the S&P 500, and
Correct.
There's already the manipulation that's kind of, there's no proof because you can't ever track that. It's in the shadow markets, all that type of stuff. But there's a lot of things going on in the option market that shows manipulation. That's really the only thing I've been able to find that could cause this market to turn around, either here or in the near, next couple of weeks. Other than outside just a normal reset rally. But I mean, a lot of the people out there, the pundits, are talking that this is just a reset down to the 200-day moving average. We've stretched so far from the 200 that we're just resetting back, and we'll be rallying.
Sure.
I saw Goldman Sachs or JP Morgan saying we're going to hit all-time highs in 2024, which it could happen. How fast this market moves, I could see that, but there's a lot going to happen between now and then.
Yeah. And, a lot of people could argue we're jumping the gun here because you're only, 4 or 5%, 6% off of the all-time highs. So, right. So, but I'm just telling you, signs are signs. Fundamentally, you brought up a lot of fundamental reasons that the market, from liquidity to all kinds of things, that should prevent the market from getting too hot. And then there is this one factor, which can happen and has happened in individual names, especially, where you could get a coordinated effort from enough institutions in the options market to manipulate or squeeze, an index or a stock higher. And if that's the case, then we'll have to adjust. But right now, based on the homework that I've done, I'm gonna continue to believe that what's hot and what's not in 2023, when we come to the end, is people are going to look back and say, you know what, the stock market wasn't nearly as hot in the last half of the year as it was in the first half, and the whole year turns out to be pretty much a wash after a bad 2022, right? So what if you're an investor, like, or if you have money in your 401k, right, and you only have stocks and bonds, what can you do? And so that's, now you've got to start looking at other areas of the market and say, okay, even though the overall stock market, let's say tech and financials and things like that, may not be looking all that hot in the charts or from the fundamentals, what's an area that does look good,